Sure. All right, so August 15th, can we call to order? Do I have a motion to call? We do that?
I'll second it.
Excellent. We have, first item is the approval of minutes from our May 11th meeting. Does anybody have any questions on the minutes from May 11th? I don't have any questions. No questions, then do I have a motion to approve the minutes from May 11th?
I'll make a motion to approve the minutes.
Second.
Approved, excellent. All right, let's move right into the second quarter investment performance review.
Great, good morning. We got everybody in a room this time, pretty much, except for Rich, it's kind of unusual, right?
Yes, we had a full room last time, so it was good.
Had this for a while. So with that, just opening up to page 1.1, just covering through to June 30th. Some of the indexes, obviously the first 6 months of the year, much better situation than the first 9 months of last year. From that standpoint, you can see the S&P for the quarter was a positive 8.74. The Russell 3000 came in at 8.39. That's what we use in your benchmark. So year to date up 16%, 16.16 to be exact. So very much so in the right direction from an equity standpoint over the last 6 months. You can see large cap is predominantly large cap growth outperforming small cap growth in general. 12.81% for the Russell 1000 growth. For the Russell 2000 growth, 7.05. So overall, large cap still outperforming small cap, which was not quite expected going into this year. Typically coming out of downturns like we had 2022, small cap will come out ahead of large cap for a few quarters. But there were some things that came along that we'll talk about a little bit more that threw that off. March, first off, being somebody the mid-sized banks struggling and becoming casualties. Basically created, more difficulties in the market that affected more of the small and mid cap companies than it did large cap companies. From that standpoint, that's really what I believe slowed down the ability for small cap to outperform large cap. They did do better in the second quarter. You can see, I think first quarter they were about 2%, and that's how much they got hit in March actually. From that standpoint, international equity. Sitting there in good shape too, really overall. We use the third index down, that's the Morgan Stanley All Country ex-US. And you can see for the quarter coming in 2.44, year to date up 9.47%. So overall, like I said, very good, stronger, positive numbers relative, especially compared to 2022. With that, the Bloomberg Ag had a bit of a rough quarter in the second quarter, coming in with a negative 0.84%. But overall, year to date, positive 2.09. And we do expect short-term turbulence here for the fixed income world, but overall, we expect to see positive numbers in the fixed income world going forward. And even eventually, we believe the ag will start being closer to 4% as opposed to 2% going forward. That's really some of that was affected by the Fed raising the rate again. And still talking about that they most likely have one more increase in them from what they're discussing. They want to end up around that 5.5 to 5.6 from the Fed rate standpoint. So most likely will be this month, next month, but there's definitely probably at least one more in from all the language they've indicated. When you move to page 1.2, overall GDP showing growth, slowed a little bit, but overall showing growth. And the labor market is kind of the wild card out here, or what I should call wild card, but the way I would describe it is unemployment is still at such a great rate that this is what's kind of, I believe, keeping us from looking at some of the other economic areas that have slowed down and coming across and saying, hey, we're actually in a recession, or we've actually truly had slowdown. Unemployment rate sitting at 3.5, 3.6% right now. Up, from 3.5 to 3.6 over a quarter. That's nothing from that standpoint. Labor participation is actually increasing, and that is a good sign. And that's in the chart in the bottom right corner of page 1.2. You can see the labor participation going up. But overall, with unemployment rate going so low, one of the key struggles is basically we're still looking for people to fill positions. So wages are still on a rise, overall, and that's definitely an effect on inflation. Now, the Fed rate and what the effort of the Fed, the chart in the bottom left corner is showing you that inflation has gone, has slowed. It's going in the right direction, meaning it's going downward. Coming off its peak, you can see the light blue line being CPI coming off of a 9% peak, headed down to 3%. And core CPI, not as high of a peak, but definitely heading in the right direction too, coming down below 6. So one of the effects here, I think, as a consumer, is people hear, okay, inflation's slowing down, and they expect prices to come down. That doesn't really happen. The prices are there. It's more that inflation slowing means it's not continuing to go up. It's it's moderating and coming down. I think it's always hard for just basically your day-to-day consumer to kind of digest and gather, because everyone's still going to the grocery store and going, wow, it still costs as much. And that's not really changing. It's just a matter of when they talk about bringing taking the growth off of inflation, keeping it from going up, it's basically keeping it from getting higher from that standpoint. So it has slowed. The Fed is still indicating they want to get it back down to 2%. I think that's going to be a difficult challenge to see if they can actually get it there. And I think it's just typically off of where wages are going. And until we would actually see the unemployment rate go up, and probably up significantly, like a couple of percentage points before we would see that. So that would be interesting, because everything is talked and pointed to if we do go into a recession. So there's still like an if there. It will be a soft landing, as they're phrasing it, something where the way I would describe it is almost like you don't feel it. You don't even realize you've been through it. The process is what they're indicating. We have to wait to see how that truly plays out. A chart on the right-hand side of 1.3 at the top. This is the manufacturing and service measurements, PMI, basically the production in the country. And the 50 line is above 50 is growth, below 50 is retraction. So you can see that it took some time, but gradually manufacturing, the blue line, went gradually down and sunk below 50. So definitely production wise, we're not producing at a growth rate. And service has come down and really just been modeling right around 50, right on that line. And when you look at service coming off of its peak of almost 67, you can see that's a significant slowdown. So we're seeing the slowdown on our production and service side as far as the economy and the way we're producing. But what we're not seeing is an unemployment rate change. Now, that unemployment usually is the lagger, but it's really not changing much. If you think about, there's some considerable announcements of layoffs at the end of 2022, and we didn't see the unemployment rate move at all. If anything, it got better. So that's to give you an idea that people rolled into other jobs. I mean, that's the main indicator. It has to indicate, because at first, the first few months, you assume that maybe they just didn't apply for unemployment yet. But when you don't see it show up 6 months after layoffs were announced, you start looking at it from the standpoint of they must have been able to roll into other employment. So those are the areas that we're looking at closely from the standpoint of where's the economy going, how's the market reacting. For example, we talked about where some of the banks, Silicon Valley Bank being kind of the headline that fell back in March. There's still a lot of pressure there. Even larger banks right now you're starting to see them kind of prepare their balance sheets to look, more funded or focused less on lending right now, because they're trying to keep all capital in to show that they're well funded. So that's another thing though that will slow economy, right? If money's not, if money's getting expensive to get to, and then banks are starting to hold back on what they're actually, lending out, that will tighten things up once again from a production and service manufacturing. It will slow things down. So that's some of the areas that we're focused on to see how that plays out from an economic standpoint. Because as I said, we're not seeing kind of some of your historical traditional type of situations go on where you come out of downturns of markets, you see small cap outperform for a while. They're still struggling. That's a lot about the mid-sized banks, like I said, struggling. So we're not seeing some of the typical historical things we see coming out of things. So we're still watching this closely and kind of watching for that. Are we actually going to fall into a recession, and then what type of recession are we in? So with that, that's kind of, as I get to our portfolio, the key there will be is you'll see that we pulled mostly the targets in the investment policy because we're taking somewhat of a what I would call a neutral stance, waiting to see how some of these things play out. But just the last thing I want to show you on page 1.6, inverted yield curve. This is yet another major indicator of economic slowdowns and going into recessions. But basically, you know, when the interest rates are higher on the short end than they are on the long end, that's your inverted yield curve. It's going to take some time to come out of this. Obviously, the Fed rate raising things up will start, yeah, and it's already started, but you know, we'll see the longer end start to increase. But for now, we're still in an inverted yield curve. As I pointed out, that is, you know, another indicator of recession, but we're not quite there yet, or at least they're not ready to call it. And obviously it usually happens after the fact anyway. They go back and look and say, okay, here's the numbers, we're there. But this is also what the Fed's watching so closely too, because they're, you know, their ultimate goal, like I said, is to get inflation back down to a 2% growth rate. So on page 1.9, this is just kind of what I was talking about with our allocation and where we're at portfolio. We pulled back, and when the bank in March hit with that information and mid cap and small cap started to struggle more, we had a slight overweight there. We actually drew it back a little bit. So we're more, like I said, we're neutral pretty much across the board. You can see in domestic equity, we're neutral across the board. International equity, the same way, neutral across the board. We just keep looking and seeing the potential for volatility at a level that could cause spiking, and we want to basically navigate through that by staying in a more neutral position. So with that, developed markets, as I said, more of a neutral spot. International small cap the same way, it's more of a neutral spot. Fixed income, we still feel like credit sensitive sectors are still the area that you can get the most gain in the fixed income world for right now. After the Fed, if they make this last rate change and they really indicate, you know, verbally that they're holding there, I think that will settle things down. It'll take a little bit of time, but you'll see fixed income start to get better on the duration side. Now we did move from a more of a negative stance on duration, which we had for years, but the Fed is running at zero. We have moved that to neutral because we do see it coming in the future to see some more capability there.
Would
So-
you consider neutral duration as far as years go?
I'd say we're around that 3 to 4. Is where we would put that in at, yeah. But you know, and when we talk about it too, from a duration standpoint, we're just talking about how much managers that have, you know, are really managing duration as opposed to managers that are more credit sensitive. So where we would with those types of industries, the way we look at it. You know, so. But moving into section 2, the executive summary is just all 4 plans in front of you. For the quarter, we came in with a positive 3.03% return. It trailed the benchmark at 3.48. So bringing us year to date wise, a good strong number at 8.27. So well above your actuarial assumption. But you know, definitely trailing the benchmark at 8.83. The first quarter was really, we got caught by the small cap overweight and what happened in March, and that pulled down our, because up until like the last 3 weeks of March, we were outperforming for the quarter, and then we got beat up the last few weeks. So that got us off to a slow start there, and just kind of gradually went through the second quarter as we adjusted the allocation in the second quarter. That's more why we trailed. Some of the managers also did not perform as well as we would like to see, and that was really the other, from an attribution report standpoint. The manager selection, it was the detraction on the portfolio more than anything else in the second quarter. But with that, overall long-term numbers wise, still sitting in a very good position. As you look out at your 5-year number, you're at 6.39 versus the benchmark market 6.27. Out from inception, which is really crucial, dating all the way back to 2003, you're at 7.11 versus the benchmark at 6.73. So, you know, the long-term numbers are very vital, very important. But, you know, obviously it's first quarter or second quarter here, we did underperform a bit. That number will actually improve a bit. You figure it's about 9.5% of your portfolio that we have in alternatives that actually for the quarter report zero. Our expectations of all those are to report positive when the numbers come in at the end. They're always a quarter behind. We'll get the 6/30 numbers pretty much at the end of September. But yeah, so that 303 return for the quarter will be a little better than that. We're expecting about 9.5% of your portfolio to have a positive return, but we don't have it there right now, number-wise. But with that, that's where the portfolio from an overall performance for each plan, how they lay out. And then I'll go in and do a little bit more in the police plan. All the police plan and the fire and the non-uniform are all laid out and allocated the same way. But just to kind of walk through year over year, page 3.4 is showing you 2022. We talked about this before, but we did we had a negative 15%, 15.8% return versus the benchmark at negative 14.76. 2021 was the exact opposite story, but a really strong outperformance, a positive 14.29 versus the benchmark at 11.62. So good strong numbers that way. 2020, good strong return there at 14.69 versus the benchmark at 14.42. 19, good strong performance there. 2018 was negative numbers, but it was outperformance. And 2017, 2016 was the last time we underperformed, up until 2022. As you see by the calendar year numbers for the whole portfolio. Switching to page 3.7. This is just, I always call this the hard dollar report, but it just gives you the hard dollar numbers as to what that return meant to you for the quarter. You have 3% return, meant a hard dollar gain of $2,095,000. Bringing your plan up, you started the quarter at $68,936,000, ending on June 30th, $71,053,000. Year to date, so the first 6 months of the year, that 8.5% return roughly turned into hard dollars, $5,450,000 for the positive. And then on a 1 year basis, return on investment on your 1 year basis, $5,890,000. So that's good to see. When you think of it, you had, the third quarter of 2022 was still a significantly negative quarter. So you add that into the last 12 months, still had a good strong gain overall. So with that being said, making a dent in the losses for 2022 without a doubt, kind of almost to a point of recovery, which is a good sign. Typically coming out of downturns like that could take 2 years, 3 years to really get back to where you were. But these past 6 months have been very strong there, how they kind of track back quickly. Page 3.8. This is just kind of showing you where we're at target wise. So you can see on the domestic equity, the dark blue is your actual allocation, the light blue is the investment policy. So this is kind of what I was talking about, we're pretty much right on target. So the target is 39% for the equity. We're at 39.8, and that was pretty much the growth of the second quarter that kind of took an overweight, that slight bit. We're not pulling that back at this point, but we're not going to add anything to actually overweight the allocation at this point. We're just pretty much going with target. You can see international right on target at 21%, and fixed income, 27 is your actual, 28 is the target. So pretty much on target. And then we go through your private equity, private debt, all those areas are pretty much right on target that we have it. Real return just a little bit less, 2.3 versus 3.3. But the other ones, like I said, private debt's at 3.3, target's 3.8, so just a little over. So pretty much right on target as we discussed. I'm sorry, those numbers get a little clumped up there. We gotta get that box bigger. So, but with that, that's the layout of the allocation. Really our viewpoint is that, for what I talked about, it's just there's still a few too many things that are out there that just have us concerned. We really haven't been able to call a recession. We don't, we looked at the way 2022 looked, it, looked like they already priced in the recession, but then we still haven't had the recession yet. So we feel like the market still has that potential to get a little bit heavy. And even we just saw it over the last couple weeks, first couple weeks of August, it started coming back from where the first 6 months went. But so like I said, I can go through each plan after that, but they all pretty much look the same.
Can I ask a quick question
Sure.
on our asset allocation? The international equity weight, I just want to understand how you guys come up with the 21, when our range is 1 to 41. It's been a drag, obviously.
Right.
Anything outside of the US is underperformed, and not saying, now's probably the best time to be an international. I just kind of want to understand how you come up with the 20, 21 in the allocation. And
About 4 to 5% of that is actually emerging markets as part of that 21. So basically,
including China,
including China, but
so
right,
you use China also.
yeah, as part of
Allocation.
as part of the allocation. Although that's been trimmed back a bit, a lot of our managers have trimmed back on China in general over the past 12 months. But yeah, so when I look at everything globally, those percentages line up more with global production. And that's, international production within the global, like this, and global production. So that's where those numbers are coming from an allocation standpoint. I actually trimmed back a little bit from our viewpoint of, where those numbers really fall in, because, we didn't want to be 29%, for example, international. So some of those numbers are trimmed back from the viewpoint. Basically, the way they view it is really looking globally, how much production is done internationally, how those percentages fall. But I believe, because what we do too is because we group the emerging markets into international, so we look at the international number looks higher, because I know I've seen other allocations where they have basically, emerging markets is a separate line, and since it's like 5-6% target, but basically since it's a separate line. So it looks like the international is lower than thought. That's all we do is combine it. But to your point, international, I'm sorry, go ahead.
One follow-up question on that. So that's fairly close to the MSCI ACWI allocation as well. So not just the production piece of it, but also the cap weighted.
Yes,
Right.
yes, that's, yeah, the other piece is the cap weighting. Yes, correct. So, but yeah, to your point though, yes, international over the last couple of years has lagged, which is not helping performance. There's a couple timeframes over the last 8 years where it's the other way around, where it needs something, and so it's just it's a time frame, obviously. Fortunately, everybody in the room has enough experience to know that, but like, it's just the time frame right now. And interestingly enough, we were actually underweighted internationally through 2022. Made that, kind of brought up the targets, at the end of 2022, going into 2023. So, last thing is page 8.4 is the attribution report. So that's the last section. The next to last section. For the yarn. So 8.4 is for the quarter. And so the total fund performance was, as I said, it was about 45 basis points behind benchmark. From an asset allocation standpoint, that's where value was added, where most of this detraction was the manager value add. But several managers underperformed. And that really was the hit. Couple in the domestic area, the active managers in the domestic large cap space underperformed as a whole, all three of them. And then a couple of the international managers underperformed, and a couple of the fixed income managers actually underperformed. So it was just about where they kind of fell in together. But uniquely enough, domestic equity, the managers have been doing pretty well there up until the past 2 quarters. They trimmed. So it's just an interesting piece. The second quarter, mostly those three large cap domestic managers actually underperformed pretty much across the board together. But that's basically, you know, where it is. And then if you drop down to the next page, same thing, that chart in the top right corner shows you that the detraction really is in the manager value add to a portfolio. The other actually falls into any trading, any cash flows, any activity like that. If it has an effect from a negative standpoint overall on the performance, that's what falls under the other block. So a little higher for the first 6 months of the year, I mean, for the 1 year number. And we did make several moves throughout 2022, trying to become more defensive as the year was going down. So I believe that's why you see, you know, larger detraction areas, because as you're making moves and kind of the decisions or the sells or changes you're making at the time, so they can have a negative effect on the portfolio.
Are there certain market conditions where managers tend to underperform or overperform?
Well, interestingly enough, especially take domestic equity, just from a standpoint of we are predominantly passive there, because, you know, we do believe it's hard to find active managers to, especially in the large cap active equity area, that can actually consistently outperform. So we look at them as adding the active piece of that.
Yeah.
We have is they're there to add value in different ways. And what I mean by that is being active in areas that are that can be more defensive when they need to be. So what you'll find is when markets take off and, you know, rise quickly, active managers, especially domestic equity managers, will tend to trim. It's almost like they can't keep up, especially if it's almost like all boats are rising. Since they're more specific, they're holding 50 holdings. There's a good chance that their 50 holdings aren't going to keep up with the 500 holdings.
Yeah.
So that's what you'll find there. Internationally, most of our international managers got caught. Basically between the war in Ukraine and interest rates changing so quickly, they just underperformed over the last 12 months. They really just got beat up. They're just, I shouldn't say the last 12 months, that's what affected through 2022.
Yeah.
Some of those managers definitely have been coming back and showing much better performance over the last 6 to 9 months. But it just depends. But I would say what you'll find with active managers, especially in the domestic equity area, is when the markets take off, because we hire the managers we hire are core managers, and these are both growth and value, so they're more core focused. So also that's another thing is as markets take off, growth kind of leads the way, and they're not full growth managers. They're still holding a good bit of value.
It seems like in the large cap space, Nuance, all cap value
Yes.
was the biggest detractor by
Right.
far. You could probably put, because you have almost 70% in the Vanguard ETF, and then Nuance is underperformed by 800 basis points year to date.
Yeah.
That's got to be probably all the underperformance.
Pretty much, yeah. No, the value, yeah. So everybody else is like, you know, within a reasonable range, but Nuance definitely got beat up. Looking at them closely.
I mean, they probably have done fine versus value,
Exactly.
but you allocated part of your
It's part
core
of your
to value.
To the value, yeah.
So it
So,
was really an allocation decision, not necessarily a manager decision.
yeah, I guess in that way, yeah.
Yeah.
On that one, because we look at the value side of it, you know, we picked that value style manager to be part of the allocation. But that's what I have for you. If you have any questions, any other questions, any more questions?
I couldn't help but notice in yesterday's newspaper, USX is in the news.
I didn't even seeing most of the articles.
Oh, yeah.
I think they have two bids out, one's Cleveland Cliffs. And, get the other company.
Yeah, it's a private firm, I think, ethics or something like that.
Right, Cleveland Cliffs is a bigger producer of steel than USX.
Well, it's interesting, yeah, the infrastructure is still like, there's a lot of dollars being pushed into infrastructure. So that's another reason why I think we're not seeing like a full economic slowdown, because there's still a lot going
Well,
on.
the government.
The government's funding it, I mean, I don't know if it's a good thing or a bad thing, that's simple, we'll see how it plays out in the long run.
Just drive around here.
Yeah, really, truly, I mean, well, and then actually.
Try to drive around here.
Yeah. Well, yeah, that's another thing. Every, where I live, because I live in Westmoreland County, right across Allegheny County, like on the edge. And two of the bridges they're working on, one's closed, the other one they're working on, and then the other bridge that would lead to where I live, it's not the bridge they're working on, it's the road that leads to the bridge leads. So there's no way to go home without sitting through some kind of, and that's not even counting 28, so, but yeah, no, we're there. But, and then like take our city alone, I mean, the bridges we have, there's still a ton more of infrastructure.
Yeah. And that was part of my questioning on the international weighting, is that there really seems to be a concerted effort. It's one of the few things in Washington, I think, where both parties are kind of aligned on the same side of onshoring more production, more manufacturing, et cetera. And yeah, and you know, it's definitely helping US corporations.
Yes.
At the expense of some of the international players. So I you know, I hate to, I know what a difficult game it is to allocate international versus US and how it does go in cycles. And we've had this 10-year cycle where the US has outperformed international. But it still seems that there's a lot of wind in the sales of the, you know, domestic markets versus the international.
Yeah, and it's
Especially when you look at China, and, you know, every corporation is faced with, you know, why are you doing business in China? You know, and you have the president saying, you are not allowed to sell China, you know, quantum computing or, you know, artificial intelligence chips, or, you know, I mean, they're basically outlawing doing business in China. So,
all of our
it
managers.
gets hard to say, oh, we should have a 5% allocation to emerging markets, when the emerging markets are getting.
And China's
Crushed
a big
by
piece of
the-
it. Yeah, and
Right.
actually, interestingly enough, that's what we've been talking to our managers about inside. This is. Get away from China, and they have, in this direction they're moving. Yeah, that's a constant discussion, because that's the other issue is, between that, like I said, the Ukraine war. It just has Europe in general kind of tied up, oil's not flowing, you know, it's definitely a tie up. But I believe part of the issue is too, is as we look at that. When that changes, it's gonna take off there, so like, you know, so I think that's part of it, but that allocation and that decision is a big one. Because going into 2022, we were about 3% overweighted. Consistently domestic equity, and the underweight was international. So we had already that outlook on it. And really now I think it's just, you know, like I said, they're looking at saying we're gonna pull a neutral spot here, just be on target. Simply because things can change so quickly there right now. And China's a big issue, there's no doubt about it, but I still think the war is the bigger issue. Because if that, you know, if that could just come to an end, then we can see how things would play out, but that's a wishing dream there, you know, from that, but that's really, I think, that's the outlying issue. You know, the more so, you know, we'll see how it plays out. It's interesting how it plays out with China too, because the next administration might say, okay, we're okay with this again, and it opens back up, so it's a, you know what I mean? It's a process, but we're still, you know.
Yeah.
We're still good where we're at from an allocation standpoint, or at least our view is on it, but that could change. There's no, because I would tell you every time, all notes coming out of our investment committee, it's there every time. You know, it's not your point is not lost on us from that standpoint. It's definitely what the committee's talking about, right? So.
I guess getting back to US Steel, I don't know, the fact that it's unsolicited makes me think, well, maybe these things happen all the time, but then it's, there's another bid coming and is it something that US Steel's actively considering, just waiting for the right price, or is just something that's typical?
It's more typical. It's probably, right now, they're probably in a growth mode and they're looking and saying. The price makes sense and they increase their production this way and.
I mean,
Think about it.
Cleveland Cliffs, but I'm talking about, US Steel's reaction. Just,
I think they're. They've been trying to figure out how to grow and compete, and the best way in that industry is through consolidation,
yeah,
and they know it. Unfortunately for Pittsburgh, because I hate to see us lose another corporate headquarters.
yeah,
Which it looks like we're probably going to do. It would have been nice if US Steel had the upper hand, but they don't.
yeah.
So
They
they're,
did 120 years ago.
well, the stock was $184 in 2008. Now they're all excited because it's at 30. So. It tells you.
Those are all you need to know.
Yeah.
Well, Cliffs has been pretty aggressive. They purchased AK. I mean, that's their plan. I mean, that's how they're going to.
Think about it, every time you do those types of mergers, you wipe out your administrative staff. You
Yeah,
save a lot of costs.
That's redundant.
What happened to Heinz?
Right,
Yeah.
that's classic.
Like I said, it's sad
The
for
Pittsburgh was.
downtown Pittsburgh.
It's amazing, so I guess it'd be about 100 years ago now, the amount of Pittsburgh, like major. S&P 500, the companies that were headquartered in Pittsburgh was phenomenal.
It was number 2, I think, at one point.
Yeah, cause I mean, even
Turn of
like,
the century.
I always forget, like Gulf Oil was here,
Yeah,
they were headquartered here. It's not one you would think, you don't think about the oil companies being here, but Gulf Oil was actually headquartered here. But anyway.
And that's going back to the international, and I think I might have asked this last time, so apologies. Or do the international managers hedge back to the dollar, or are they unhedged? Or does it vary depending on?
They hedge back to the dollar.
They are, okay. So when the dollar fell last year in Q4, they didn't really. That wasn't a tailwind for them any longer if they were hedging back then. Right?
And actually, international is probably where we have more active management, but in general, we're still predominantly passive.
We need a vote to approve that, I forget.
No,
Okay.
no.
All right, we'll move on. Any new business to discuss?
I have none.
Now, motion to adjourn.
Second.
Motion to adjourn. Thank you. Second. All right.
See y'all next time.
Very good.